Welcome. In the next 10 minutes, you'll learn how options actually work from the ground up. We'll start with how to read red and green candlesticks, then break down what an option really is, how calls and puts make money, what the premium is made of, and the Greeks that drive it. Then we'll build 7 classic strategies, from steady income plays to volatility bets, each one with its payoff diagram. By the end, you'll be able to look at any basic options position and know exactly where it wins and where it loses. Let's get started. First, the language of every price chart, the candlestick. Each candle summarizes one period of trading. The thick body shows where price opened and where it closed. The thin wicks show the highest and lowest prices reached. A green candle means the close was above the open, buyers won that round. A red candle means the close was below the open, sellers won. A long body signals strong conviction. Long wicks signal a battle, price pushed far, but got rejected. String candles together, and you can read the story of a stock, momentum, hesitation, and reversal. Now, what is an option? An option is a contract tied to a stock. It gives the buyer the right but never the obligation to buy or sell 100 shares at a fixed price, called the strike, on or before a set date, the expiration. For that right, the buyer pays a fee up front called the premium. That's the entire machine. 3 dials: strike, expiration, and premium. Every strategy you'll ever see is just a combination of these contracts, arranged to profit from a specific view of the market. A call option is the right to buy. Say a stock trades at $100 and you buy a call with a 105 strike for $2. If the stock rallies to 115, you can buy at 105 and the contract is worth $10, 5 times your money. If the stock stays below 105, you let it expire and you lose only the $2 premium. Look at the payoff diagram. Below the strike, a flat red floor, your loss is capped. Above it, the green line climbs without limit. Small defined risk, open-ended reward. The put option is the mirror image, the right to sell. If you buy a put with a 95 strike and the stock drops to 80, you can still sell at 95, and that $15 difference is your gain. Puts get more valuable as the stock falls. On the payoff diagram, the green profit zone now lives on the left, where prices are low, and the red zone sits on the right. Traders buy puts to profit from declines or to protect shares they already own, like insurance against a crash. Here's what most beginners miss. Every option has 2 sides. For every buyer, there's a seller, also called the rider, who collects the premium up front and takes on the obligation. Sell a call, and you must deliver shares if the buyer exercises. Sell a put, and you must buy shares at the strike. The seller's payoff is the buyer's, flipped upside down. Their maximum gain is the premium, but their potential loss can be large. Sellers win when the option expires worthless, and statistically, many options do. Premium sellers trade a high win rate for occasional big losses. Traders describe options by moneyness. An option is in the money if exercising it right now would have value, a call below the stock price, or a put above it. It's at the money when the strike sits right at the current price, and it's out of the money when it has no exercise value yet. Out of the money options are cheaper, but they are lottery tickets, they need a bigger move to pay off. In the money options cost more, but behave more like the stock itself. Where you place your strike is where you place your bet. So what determines the premium? 2 ingredients. Intrinsic value is the real, exercisable value, how deep in the money the option is. Time value is everything else, the market's price for possibility. More time and more volatility mean more time value. And here's the catch, time value melts every single day, a decay called theta. It's slow at first, then accelerates sharply in the final weeks before expiration. Option buyers are racing the clock. Option sellers are collecting rent from it. 3 Greeks tell you how your option will behave. Delta measures direction, how much the option price moves when the stock moves $1. A 50 delta call gains about 50 cents per dollar of stock. Theta measures time, how much value drips away each day. Vega measures volatility, how much the price changes when the market's expectations swing. You don't need advanced math. Just remember, delta is your direction, theta is your rent, and vega is your exposure to fear and excitement. Now let's build strategies. Strategy 1, the covered call. You own 100 shares and you sell a call above the current price. You pocket the premium immediately. If the stock drifts sideways or rises modestly, that premium is pure extra income and you can repeat it month after month. The trade-off shows in the payoff diagram. Above the strike, your profit flattens, the shares get called away, and you miss the extra upside. It's a strategy for stocks you like, but don't expect to explode. Strategy 2, the cash-secured put. You want to buy a stock, but you'd love a discount. So you sell a put at the price you'd happily pay and hold enough cash to buy the shares. If the stock stays up, the put expires and you keep the premium as pure income. If the stock falls below your strike, you buy the shares you wanted anyway, effectively cheaper by the premium you collected. Either outcome is acceptable, that's the beauty. The risk is the same as owning stock from the strike down. Strategy 3, the protective put. You own shares and you buy a put below the current price. Now look at the payoff. No matter how hard the stock crashes, your loss stops at the strike. The red zone has a hard floor. Above it, you keep the full upside, minus the premium you paid. This is portfolio insurance, plain and simple. It costs money. Most of the time it expires worthless, just like your car insurance, but in a crash, it's the best position on your books. Combine those last two ideas and you get the collar. You own shares, buy a protective put below, and pay for it by selling a covered call above. Often the premiums cancel out, a near zero cost structure. The payoff is a band, your downside is floored by the put, your upside is capped by the call, and in between, you move with the stock. Investors use collars to lock a profitable position through uncertain events, earnings, elections, or just a nervous market. Strategy 5, the long straddle. Buy a call and a put at the same strike, usually at the money. Now you don't care about direction at all. The payoff is a V. If the stock rockets up, the call pays. If it collapses, the put pays. You lose only in the quiet middle where the move is too small to cover both premiums. Straddles shine ahead of binary events, earnings reports, product launches, court rulings when you expect an explosion but can't predict the direction. The Strangle is the straddle's cheaper cousin. Instead of one strike, you buy an out-of-the-money call above and an out-of-the-money put below. Both are cheaper, so your total cost drops and so does your break-even risk. The trade-off, the stock must travel further before either side pays off. The flat red valley in the middle is wider. Same volatility bet, lower cost, bigger required move. Choose based on how violent you expect the move to be. Strategy 7, the vertical spread. Here's the bull call spread, buy a call at one strike and sell another call at a higher strike. The sold call's premium discounts your cost, and in exchange, your profit is capped at the upper strike. The result is a defined risk, defined reward box. You know your maximum loss and maximum gain before you ever click buy. Spreads are how professionals express a directional view without paying full price for it, and they come in bullish and bearish flavors alike. One more for the advanced curious, the iron Condor. Sell an out-of-the-money put spread below the market and an out-of-the-money call spread above it. You collect premium from both sides, and you profit if the stock simply stays inside the range until expiration. The payoff looks like a plateau, steady income in the middle, defined losses at the wings. It's a bet on boredom, and in sideways markets, boredom pays. So which strategy do you choose? Match it to your outlook. If you're bullish, buy calls, use a bull call spread, or sell a cash-secured put to enter cheaper. If you're bearish, buy puts or use a bear spread. If you expect a sideways, quiet market, sell covered calls or trade an iron Condor and collect the rent. And if you expect a big move but don't know the direction, that's straddle and strangle territory. Outlook first, strategy second, never the other way around. And avoid the 4 classic beginner mistakes. Buying far out of the money weekly options, they're cheap because they almost always expire worthless. Holding losing options through time decay, hoping for a comeback while theta eats the position alive. Sizing too big, one bad trade should never dent your account. And ignoring liquidity, wide bid-ask spreads quietly tax every entry and exit. Trade liquid names, near dated but not expiring, sized small, with a plan. Before you trade a single contract, burn these rules in. 1. Risk only a small slice of your account on any single position. Options can go to 0. 2. Prefer defined risk structures while you learn, spreads over naked positions. Always know your maximum loss. 3. Respect expiration. Theta accelerates in the final weeks and out-of-the-money options usually die worthless. 4. Paper trade every strategy before real money. The market will always be there tomorrow. Make sure your capital is too. Let's recap. Candles show you the battle between buyers and sellers. Options give you the right, not the obligation, with strike, expiration, and premium as the 3 dials. Calls profit up, puts profit down, sellers collect rent, and the Greeks tell you how it all breathes. And you now have 7 strategies, from covered calls to iron condors, each with a payoff picture you can read at a glance. If this helped you, subscribe to this channel for more clear, visual market explainers, and I'll see you in the next one.